Investors are like leprechauns. They're always chasing after that crock of gold. That's why they're always open to entertaining and weird and wonderful investment ideas. But sometimes the most boring of investments can end up being the most lucrative when used the right way. In this video, I'm going to show you the power of income funds to double your money in just 5 years. This is particularly powerful for those of you who are approaching retirement and feel like you're a bit short because after all of the kids and after all of universities and all of the mortgages, you feel like you don't actually have that much left. Don't worry, there is hope for you. I'll share with you 4 viable income options available out there for you today. I'll compare income funds to savings accounts, and I'll show you a way that you can make your investments completely tax efficient. Let's begin. Compound interest or compound growth is one of the great financial miracles of the world. Really simply, it's like a snowball at the top of a hill. It starts off tiny, but by the end of it, it is enormous. And each new turn towards the bottom of the hill, it is picking up more and more snow as its surface area is larger. So the last few turns, it actually ends up growing the most. So let's put it another way. What do you think is better as an investment? £1 million that I will give you today, or 1p doubled every day for 30 days. Many people would instinctively say £1 million today because it's a large number. But if they just hold on for 30 days, they would have ended up with, wait for it, £5.3 million. So far more than £1 million. And as you can see, for much of that initial period where you go from 1p to 2p to 4p to 8p, you're not exactly becoming rich. But this goes to show precisely the power of having a plan and just holding for the long term, holding through that first 10-15 days and using compound growth to your advantage to accelerate over the last few days. So how do you double your net worth in 5 years then? Well, the key rule is that you need to be investing in something that is making you over 7% at least, because that will enable you to double your money in 10 years. But if you want to double your money in 5 years, you will also need to invest every single year an additional amount of 10% of that total pot. Let me put it practically. So let's say you start off with £100,000. Every year you add on an extra £10,000 into that pot of new savings. You're making a 7% return annually. After 5 years, your total will be £199,533. So you have doubled your money from where you started. Now, turning to what you can actually put your money into. There are a number of income investments out there, but for this video, I won't be discussing anything that will make you less than 7% because of course that's where our focus is right now. Option number 1 is rental property. Literally just buying a property and renting it out. In the north of the UK or in cities like Dubai, Istanbul, Fez, in Morocco and other places, you can actually generate yields of north of 7% and sometimes as high as 12 to 15% as well in touristy areas. The downside with this route is that you typically need a large amount of cash up front, or you need to deploy a very large chunk of your portfolio into a single asset, and you will need to then factor in all of the management and maintenance costs, and you need to have the know-how and access to be able to buy the properties that you should be buying. Of course, there are also a whole load of fees associated with things as well, and you need to factor in your ongoing expenses as well. And all of this adds up and it really does eat away at your profits. And then there's a time commitment from your side as well to manage the entire property, especially if you're renting out residential units rather than commercial units. Doing it yourself can actually be quite appealing though, is if you have a larger portfolio and potentially you're getting economies of scale and you might even hire someone to manage it for you, then it can be quite appealing. An alternative is investing in a real estate fund, such as the Rasmullah real estate fund that we've got on the platform or the community healthcare fund, which is coming very shortly. We've done a detailed video about this fund here, but in a summary, this is effectively you getting exposure to a full portfolio of rental properties without needing to have the millions that would have been required to actually buy it in the first place, and without you needing to have to do any of the work. The upside of this is that you get capital appreciation, which can be substantial at times, but the downside of this is that, of course, you're going to have to pay fees for this, and also your typical property fund will yield you a little bit lower than your pure income fund. And in this case, the fund is currently offering around the 3.5%, 4.5% 5% mark and will slowly climb to about 6 or 7% over the next few years. So you are foregoing some of the income for the promise of capital growth that is going to be larger over a period of time. Next, you can be investing in the public markets. You could be investing in the Islamic equivalent of bonds, which are called sukuk. Now, there are some really low risk sukuk that are offered by governments, which are going to be yielding you 3, 4, 5%, which are not that appealing for the purposes of trying to hit 7%. But then you have certain sukuk, like for example, recently Sanomi supermarkets in the Middle East, they issued a sukuk and they were offering in the region of 7 to 8% when it was first issued. You can also buy sukuk from the Turkish government and some of even the Pakistani government, and these can be much more attractive in terms of yield, but also, of course, a bit more higher risk. The first problem you have with these investments is they are USD investments, so you need to take the currency risk if your native currency is other than USD. The second issue is that you need to have a good quality broker network in the Middle East, because otherwise you're not going to be able to access these investments. And sadly, for most people, that is usually not the case. And you will need to usually have about £250,000 minimum to be able to get the broker accounts needed that will give you access to this stuff. Finally, you have our Curate Income Fund offering a return of 7.25 to 7.5%. The fund is a diversified portfolio of mainly property financing and rental properties, which provides the security behind the investment and the spread of the exposure of what you're investing in. And you can invest in the fund with 3 months notice, and you can also invest in it through an ISA, which is a tax wrapper, which makes it tax efficient for UK investors. And of course, you're not losing out if you're not in the UK as well. It doesn't lose you anything. The downsides to the fund are that you are giving up capital appreciation that you would get if you are directly investing in property. But the upside is that you are going to get a more certain income return that you can reinvest and compound over time. So where would I invest? To be honest, you can't really go far wrong with any of the approaches that I've discussed today. But if you're focused on clean income without any expenses or taxes or any hard work, then I would focus on the sukuk if you can get access, or the Curate Income Fund as well. If you're happy to take a bit of a hit on the income coming in, but you really want the capital appreciation, which will add up to more over time, then the other two options of going down the real estate route would be the more suitable options. But if you go down that route, then there are some other broader options to consider as well. You could basically consider all of the REITs out there on the publicly listed markets and make sure they're Sharia compliant. You could also look at lots of crowdfunding platforms that give you access to property as well, such as Smart Crowd, Republic, Wahid Real Estate, Yielders, Get Stake, and there are others out there as well. And as I mentioned earlier, Curate is also about to launch a very exciting new fund focused around community healthcare buildings such as pharmacies, dentists, and GPs. So watch out for that as well. We'll do a separate video on that in due course. But hang on, Ibrahim, thanks for all of that. You haven't mentioned savings accounts at all. Why? Okay, let's face into savings accounts right now. How do these investment options compare against a bank savings account? Well, for a start, a typical bank savings account is much lower yielding. You're looking at somewhere between 3 and 5%. Given inflation is somewhere in the region of 5% and has been as high as 10% over the last few years, by putting your money in a savings account, you're effectively losing money, or at best, you're just letting it maintain its value. Zakat is also then going to come on top of that, and you're going to be eaten away by 2.5%. Of course, we want to give zakat, but it's something that you want to consider. Why on earth would you take that as an investment strategy when you want to grow your money? And you guys do realize what banks do, right? They just take your money and offer property financing and business financing, the kind that we've been discussing in this video and others, and make much more than the 3 or 4% that they are offering you. Now, of course, look, there are benefits to savings accounts as well. They're protected up to 85,000 by the FSCS, and in the USA there is a similar scheme as well, and there is therefore an incredible safety to an savings account from a bank in the UK or the USA. So if you are genuinely holding for short periods and you need complete certainty that your money will be there for you when you need it, then savings accounts are great for that, and they are an important product and an important tool as part of the mix of investment portfolios that you put together. We use them ourselves with Curate Capital, but we need to play them in at the right time. But long term, you really should be looking at things other than savings accounts, because if you put your money into a savings account out, in the long term, you're going to be in exactly the same place that you started at. And if inflation goes up, then you will end up in a worse place than when you started. So you would be losing money hand over fist. So yeah, sure, it's safe in one respect, but actually, if you're losing a whole load of money, I'm not sure if I would take that safety. And the other fact is that most people, Muslims, will actually end up holding the money in savings accounts that are from conventional banks. And so of course, any of the interest there is haram anyway, so you're gonna have to give that away. So that really is shooting yourself in the foot multiple times over and then chopping your foot off as well. Okay, so now you know savings accounts are not the ideal place for long-term holding of cash. Let's cover off the other key area that most folks end up misstepping on: tax and accounting and expenses. All too often, folks focus on the top level returns without actually getting into the nitty gritty and properly working out the actual returns. Let me show you what I mean. Now look, if you invested 100,000 in property in the UK, this is how the commercials would typically play out. Rent, you might be getting about 8,000 coming in at the top level, 8% rent. But the legal fees that you would be paying right at the start and right at the end when you exit, let's blend those all out. Let's say on average, you're paying about £800 in legal fees per annum. Then you've got your annual agent fees, which is about 10% of the rent, so £800 there. Then let's accommodate for about £800 worth of upkeep that you're going to spend on the property on average for each of these years. Then you take into account the income tax or the corporation tax. Let's say that you go for the income tax route and you're getting charged at the higher rate, which is 40%. You would then end up paying £3,360 in tax as well. So the actual real yield is going to end up being much closer to 3.36%, which is actually not that attractive. So how do we avoid all this tax? Well, the way to do that is to invest it via ISAs in the UK or IRAs and equivalent in the USA. There are two types of ISAs out there that are particularly relevant. One is the normal stocks and shares ISA, where you could go and buy REITs or other property related companies. The yields that you will receive through that are dependent, of course, on what price you entered the REIT at and also how the REIT performs. Typically, as these are much larger funds with significant overhangs, the kinds of yields you see are in the range of about 2 up to about 4, sometimes 5%. And when you take off the management fee of 0.5 to 1, sometimes 2%, you end up in pretty much the same place as if you had just bought a property yourself and were managing it yourself. Through a stocks and shares ISA, one thing to remember is that you typically can't buy income funds such as the Curate one through that. But all is not lost. Enter the Innovative Finance ISA. This is the ISA wrapper for fixed income investments that the government introduced that the Curate Income Fund and other platforms take advantage of. So now your investment returns come back to you tax-free. And if you're an overseas investor, we will of course send the returns back to you untaxed, and then it is your responsibility in your country how you handle the taxes over there. So we won't be deducting any taxes on our end. And the other key thing to consider when we're talking about ISA products is that they are seen as debt-like products. So you are getting a net return. So if, for example, our income fund says you get 7.5%, then that is the return that you should be expecting without any additional expenses or fees taken off from that. You would, of course, as mentioned previously, give up some of your capital growth, but that's the thing that you need to weigh up. Income funds are a vital tool in any investor's toolkit, particularly as you start approaching retirement. But frankly, pretty much at all times of your life, having a portion of your portfolio sat in something a little bit lower risk and easy to get out of can be quite helpful. So folks, put away your money into investments yielding 7% plus and make sure you're saving up at least 10% of your total pot, and you will double your money mathematically in 5 years. And folks who are saving for retirement and who have a specific goal in mind for 5 years' time, this strategy is a pretty foolproof way of getting there on autopilot. Please remember to like this video and subscribe to the channel and share it with your friends and family. That's the only way we grow and we can make more videos like this. Let me know in the comments below what you make of this strategy and any other advice that you would add from your personal experience when dealing with income investments. Until next time, Assalamu alaikum.